Yeah. So, good evening, everyone. Am I audible?
Good evening, sir. Yes, sir.
Yeah. Okay. So, we'll take a 5 minute time, or sorry, 2 3 minute, and then we start. Okay. So, we'll start now. Today, we start with the security valuation. Okay. So, like absolute value model. So, whenever you are giving any, जैसे like market में मेरे को मालूम है कि ये property इतने का मिलता है, okay? तो उस बेसिस पे यानी asset का जो valuation है on the basis of market, okay? तो that we need to consider as an absolute value. अब होता क्या है कि कई बार comparable product नहीं है, okay? Sorry. Okay. Sometimes what happened, we don't have a comparable product. So in that situation, what we need to do, we need to estimate the cash flow and we need to discount it. Okay. See, first aspect, if you want to value any security, okay, so either you know the market price if it is readily tradable, okay, and then you can estimate the price of that security or value of that security. Okay, so you know the market price because it is a tradable. Okay, so you know the market price and you can estimate the value of security. But if it is not tradable, not tradable. Okay, so in that situation, how you can calculate? You can estimate the cash flow and then calculate the present value. Okay, how we are going to calculate the present value? By applying the proper discounting factor. Applying proper discounting factor. Okay, so we are going to learn each and every statement here. So if I consider the stock XYZ, okay, it is a tradable, and the recent transaction happened $50 per share. Okay, so if any investor or any person, any corporate have a $10 shares of stock XYZ, so what is the value of his security? Any guess?
$500.
Yes, 50 multiplied by 10, it is $500. Okay, now what happened? You invested in a private limited company. Okay, and now say for you have invested 20%, and the amount for that 20%, maybe you paid 100,000 dollar. Okay, and now you want to calculate what is the value of this security, $100,000 security. So how you are going to calculate? Any guess? Okay, so we go one by one. If this company give you the dividend of say for 5%, so 5% of 100,000, which is 5,000, you will get the yearly dividend. Okay, now we consider first that I mean your objective is basically like you need to maintain the investment for 3 years. So you will get the 5,000 for 3 years, and at the end of third year, you are going to sell your shares at a 10% growth. So you will get after 3 years 110,000. Okay, your expected income is say for 15%. Okay, so what we are going to do, we are applying the discounting factor. So it is discounting factor, how we are going to calculate? 1 divided by 1 plus a rate of interest rate expected, or a hurdle rate. Okay, for second year, for third year, and this is at the end of third year, so we need to consider the same. So what we are calculate here, we are calculating the discounting value of future cash flow on my 100,000 investment. So it is 83,742. So what is the present value? It is 83,742.91. So even though the historical cost $100,000, but the present value of this security is 83,742. Okay, so present value. So it is an option with you whether you need to disclose in your balance sheet at historical cost or with the fair market value or the present value. Okay, so this way we are going to calculate. Okay, so first what we need to know means for what period we are maintaining the investment. Okay, and for what period we are maintaining the investment, and what is my terminal cash flow. Okay, because when you are going to liquidate, if you decided, okay, I may get a growth of 30%, okay, so this will become 130,000. So my valuation get changed like this. Okay, so this way we are going to calculate. Okay, now the second question is, if it is a perpetual means you are not going to withdraw, you will get the return every time. You will get the return. Okay, so here we consider the 5% return we are getting it. Okay, so in that situation, what is the valuation of the security? Okay, anyone has any idea, or anyone can tell something? See here, we know like my term of investment is limited. Okay, so you need to calculate like this. You need to apply the discounting factor. Okay, whatever maybe you need to first project whatever may be your future cash flow, and then apply the discounting factor, and whatever may be the present value, that is valuation of your security. But now there is no period limitation. It is basically you can like keep an investment forever period, and you will get every year 5% dividend. Okay, so see, again my expected rate of return 15%. How much I am getting? 5% means 5,000. This is on my face value 100,000. Okay, my expected rate of return is 15%. Okay, so 5,000 divided by 15%. That is basically, so it is 33,000 is the value of security. Okay, so even though I purchased the security at 100,000, okay, but the value of the security is 33,000. Why? Because I am getting a dividend at a 5%, but I am my expected rate of return is 15%. In practical scenario, there is no that much gap. It is basically sometime it is 6%, and expected rate of return is 7%. Okay, so it is not it is basically altogether 1/3. Okay, so in when the investment is for a perpetual period, okay, so at that time, okay, so when the investment period is for perpetual period, okay, for a perpetual period, so at that time we just need to, whatever may be the my cash flow, whatever may be, sorry, whatever may be my cash flow, divide by expected rate of return. Okay, so this way we need to calculate. Any doubt here? Okay, then we just skip one concept. Discounting, how to calculate the discounting factor? Is everyone aware, or I will give a detailed explanation on it?
Sir, I have a question.
Yeah.
Sir, in the CPA exams, the discounting factor they would have given in the question, or should we do it?
No, mostly it is given.
For PV and EV, both tables will be given, sir.
Both. Yes. They will give, but they will confuse in such a way. We are going to discuss NET due and ordinary NET. There is that kind of confusion may arise. They will give the data for for 5%, 6%, 7%. Okay, you need to select proper. What you need to select actually. Okay, so
Okay,
they're
sir.
confusing in that way, but you do not require to calculate actually.
Okay, sir.
Okay, So discounting factor means I'm value of 1 rupee. Okay, what is my like future value, or sorry, present value? Means if I'm getting a 1 rupee after 1 year. Okay, so what is the today's value? That is basically the discounting factor. If I'm getting a 1 year after 1 rupee after 1 year. Okay, so what I'm doing, I'm losing the earning opportunity for that year, losing earning opportunity because I'm getting after 1 year. Okay, if I'm losing an earning opportunity, so what is, I mean, how much amount I lost? So say for the 15% is basically the return, or I'll keep it simple, 10% is basically the return. Okay, so what happened? One I'm getting after 1 year, which is including this 10% return. So that's why I need to divide 1.1, which is 0.91. So today's value is basically for my, I mean, if I'm getting an 1 rupee after 1 year, so this today's value is 0.91. Now you can cross check. Like if 0.91 I invested today, then I may earn the 10%, which is 0.09. Okay, and this will become a 1. Okay, so after 1 year, I mean, if I invest today 0.91, so after 1 year I'm getting an 1. So, and the 10% is discounting rate, okay, or expected return or hurdle rate, okay. So that you are going to use for calculating, for calculation of the discounting factor, okay. So whenever you are calculating the discounting factor, you need to divide. Okay, that is basically 1 plus r. Okay, and then if for a multiple period, then it is n. This is basically, so that is basically for discounting factor. Discounting factor, and we are calculating the present value. There is a two word, present value and future value. So whenever we are calculating the present value, you need to divide, and whenever we are calculating the future value, you need to multiply. Future value is what? I invested today 1 rupee. Okay. What is the valuation of this 1 rupee after 1 year? So it is, because this will earn the 10%. Okay. So this will 1 plus 0.1 equals to 1.1, like this. Okay. And the same way, if you calculate 1 multiplied by 110%. Okay. Or 1.1. Okay, so this is 1.1, and if you divide 1 divided by 1.1, then it is 0.91, like this. Okay, so you just need to keep in mind, if you are going to calculate the present value, then you need to divide with the discounting factor, and if you calculate the fair value, we will call it a multiplier. Okay, means the same thing, expected rate of return, but in case of a present value, it is discounting, and for future value, it is multiplier. Clear? Then annuities. Okay, so there is a annuity due, two words, just need to keep in mind. Okay, annuity is basically you are invested some amount, and you, on the basis of that amount, you are getting a fixed amount every year. Okay, so again you are getting amount in a future. Okay, so it is basically like series of cash flow. Cash flow. Okay, now there are two words, annuity due and annuity ordinary. Okay, in annuity due in first month itself or first year itself, you are receiving the first installment, or you need to pay first installment. Okay, means like if you take a loan today, then your first installment due on the date of loan. Date of loan. That is basically the annuity due. And in ordinary annuity, first installment due on after end of the year. Generally, for lease calculation, we are adopting this concept after end of the year. Okay, we will take an example. Say for you took a loan, and for that you need to pay every year 30,000. I will take a 5 years. Rate of interest is 10%. Okay. I hope you are able to see my screen. Okay. So the discounting factor, okay. So, means if you see, the two sequence of discounting factor, okay. In column C, it started from 1, and in column D, it started from 90. Okay. So, what happened here? It is basically annuity due. I am paying immediately. So this value of this 30,000 is 30,000 itself. Means if we multiply this, so 30,000 itself. Okay. But if I am paying after 1 year, so this is basically the ordinary annuity. If after I am paying after 1 year, then 30,000 multiplied by 9091. So I'll calculate. Okay. So if you see this, like in case of the annuity due, the value is 125,096, and in case of the ordinary annuity, the value is 113,723. Why this happened? Because if I'm paying the first installment immediately, I will lose the benefit of earning opportunity. So that's why I need to pay more amount. But if I pay the first installment after 1 year, okay, so in that situation, I may earn some amount on that year. Okay, so that's why the value is less, means the value of liability is less. Are you able to understand what is the difference in annuity due and the ordinary annuity? First thing, annuity is basically when there is a like series of payment. Okay, I consider the single payment. It may possible the payment is like not a single one. Maybe there is a 5% increase every year. That is also possible. Okay, so it will not affect actually. Okay, so it depends on the means whatever may be the terms and condition. Okay, so this way, and like if you are paying on the first day of the loan taken, okay, so then you need to start with the one, and if you are paying after 1 year, because you are able to earn the some amount on the first installment, so you need to start with 0.90, means 1 divided by 1.1. Clear here? Any doubt here? Okay. So annuity due or ordinary annuity, we are considering only when there is a limited series of payment. If it is a perpetual, then we already discussed. It is basically whatever may be the amount we are going to pay or we are going to receive divided by expected rate of return. So it is basically 33,333. Okay. Okay. So like you can consider here, stock price that we need to calculate. And this is basically the stock price we are calculating. This is dividend, means the single amount we are getting every year, same amount we are getting every year, and this is my expected rate of return. Okay, so what happened in general, even though the share value is 1 lakh, okay, in market everyone is going to buy at 33,333, like this. This may be the face value, but not the market value. Okay, market value is this one. Okay, so whenever you are investing in a private companies, okay, and whatever may be the amount you are receiving, okay, so what you need to do, I mean, if there is a fixed commitment that you are getting that much dividend, so you need to make sure before investment, like whatever may be the market value, and then you are going to invest, or you can negotiate with the company. Okay, even though the face value is 100,000. Okay, but if they can pay the 5,000 per year perpetually, okay, so then you should not invest more than three, and your expected rate of return is 15%. Then you should not invest 33,000 more than 33,333. Clear? So here zero growth rate means the same amount you are getting year on year basis. Okay, but it may possible like here. I mean, in this cash flow, when I apply the 5% growth in every year. Okay, so in that situation, the formula is something different. We can see this. This is basically the. Okay, this is one example actually. Yeah. So Baker Corporation pays a constant annual dividend of $5 per year. Able want to invest in a Baker and earn 20% return. So 5 divided by 20%. Okay, so it is basically the 25. So for earning $5 and he expected 20% return, so he should not pay the price to acquire the shares more than 25. This is basically the market value. Clear? Now the Gordon growth dividend discount model. So here what happened, the same example, previous one we will take, the face value 100,000, dividend rate 5%, expected rate of return 15%. One additional information, that is basically the growth rate. Means like 5% is 5,000, but it is not the case every year you are getting a 5,000. You will get the growth rate of 10%. 10%. Okay, now we need to calculate. Okay, see, this 5% is for the D0 period. D0, and the 10% means 5,000 multiplied by 10%, how much? 5,500. So this is D1. That also you need to keep in mind. Whenever you are calculating calculating the share value with dividend discount model or Gordon growth model. Yeah, Gordon growth model. Okay, so you need to consider the dividend amount after a period or after 1 year. Okay, not last year dividend. Okay, in first case we consider last year dividend or after, because the amount is same, so that's why it is not impacted. But here you need to consider after 1 year. If you want to calculate the price as on today, then in the, I mean, once you invest whatever the amount you are receiving, so that's why the expected dividend that you need to consider, not last dividend. In examination, they will give the last dividend amount plus growth rate. Okay, so in that situation, you need to first calculate the D1. Okay, that is basically the D0 multiplied by growth rate. Okay, so in this situation, it is 5,000 multiplied by 110%, which is 5,500. Clear? So that you need to keep in mind. It means D1, D0, D1 that you need to consider. Okay, and you need to calculate the dividend which you are receiving, expected dividend. Okay, for calculating the price as on today, means how much amount you supposed to invest today so that you will get the dividend. Okay, that we are calculating. So that's why you need to consider 5,500. So what is basically the formula? I'm just comparing with the perpetuity. Price equals to dividend divided by R, expected rate of return. Now there is a slight modification. So it is D1 or D0 multiplied by 1 plus growth rate. Okay. So either you can consider D1 or you can consider this one, one of the same thing. Okay. But what happened, instead of R, you need to mention R minus growth rate. Okay. So in this situation, 5,500 divided by 15% is my expected rate of return minus 10% growth return. Okay, so how much I can get? 5,500 divided by 5%. Okay, now we need to calculate. It is 1,10,000. The value of the share is 1,10,000. Okay, so see, if you are giving up, I mean, like the face value 1 lakh. Okay, dividend 5%. Okay, so if dividend is 5%, amount is 5,000. Okay, if there is no growth, in that situation, value of the share is 33,333. But if there is a 10% growth, then the value is 1,10,000. Clear? Because of growth rate, you are getting an additional amount. Okay, so that also we need to discount. Any doubt here? Okay, before going to second one, next one. So yeah, because you are getting a 5-7 questions, keep in mind. So that's why any issue, I mean, if you feel that we need to repeat, then we can discuss. Okay. So 2 point you just need to keep in mind. In case of the perpetuity, if there is a fixed amount you are getting throughout the life, then the calculation is very simple. Whatever the amount you are receiving, divide by expected rate of return. But if you are getting growth on every year, then you need to consider first the dividend, which is D1. Okay, just keep in mind. Okay, I mean the way I'm keeping in my mind. Okay, so last year dividend is D0 and the expected dividend is D1. So if they gave the expected dividend, then you do not require to apply the growth rate. If they are not giving the expected dividend, then you need to apply the growth rate and calculate the expected dividend. So sometime in a question, it may happen. Last year dividend is 5,000. expected dividend $6,000 and the growth rate is 10%. 10%. Okay. So what is the D1 here? See, if you see calculation, expected dividend, one is 6,000 and grow. If I calculate the growth rate, then it is a 5,500. Okay. So which amount you are going to use for the calculation? Any guess? Yes. Either 6,000 or 5,500. Anyone can guess?
The 6,000.
Yes. So you need to consider the 6,000. The meaning of this kind of statement is basically this 10% applicable after this dividend declared or issued. Okay, so you need to consider if it is clearly given the expected dividend, then you need to consider that amount only. You do not require to calculate. But if it is not given, okay, so then you have a only choice to consider 5,500. Okay. Next. This is basically the CAPM model. Okay. In CAPM model, what we are calculate here, first expected rate of return. I'll just write expected like this. Okay. Okay. How you are going to calculate? Okay. I'll just, instead of writing like this, okay. How you expect the rate of return. Okay. So that is basically, how I can say, risk-free rate of return. Okay, like if you invest in an FD or if you invest in any security which is backed by the government insurance, and whatever the interest they are giving, that is basically my risk-free rate of return. Okay, there is no risk at all. You will get your money. In fact, if you deposit in a bank, okay, so bank may bankrupt or they may not in position to refund your deposit, but when you are invested in a government securities, particularly when the government is giving an insurance for those security, so whatever the return they are giving, that is my risk-free rate of return. Okay, so you just need to invest and forget you are not taking any single risk. Okay, so whatever the amount you are getting, that is basically risk-free rate of return plus. Okay, so when you are invested in a particular corporate, okay, so how you calculate means whatever the risk-free rate of return that you need it, you are not going to okay or accept below this. Okay, but as you are invest in a private corporation, okay, or the corporate where you are not sure whether you will get the money or not, so you are taking a risk. So I'm calling it as a risk premium. In past, okay, if that corporate always pay at committed time, so maybe the risk premium is less. Why? Because they always meet out their commitment. Okay, but still you are charged the risk premium because it is not secured by government. So there is some risk. Okay, again the return is depend on the business. So some risk. Okay, but if they defaulted earlier, so there is a high chances of further default. So that's why the risk premium is high. Okay, so that you need to keep in mind. So this is, and just giving an example so that you can understand. So whenever you are, means if I say my expected rate of return is 15%, okay, what is the breakup of that 15%? Say for government, I'm getting an interest on security, which is backed by the government insurance, which is 5%. Okay, so that is my risk-free rate of return, and plus I feel if I invest in this company, at least I should take a additional amount because I'm carrying some risk, which is 10%. Okay, so this way it has become a 15%. Okay, no one is going to invest the amount in any corporation or the company which is less than 5%. Less than 5%, because if you want to invest for a less than, I mean, if there is a relation exists, that is a separate issue. But if you require to invest for a less than 5%, if he is getting a return which is less than 5%, he will better to invest in a government security. So that's why no one is interested to invest in a corporate who is giving them a return of less than 5%, particularly when the risk-free rate of return is 5%. Okay, now, so this is risk-free rate of return, and now the security premium. Okay, so what I am calculate here, beta, I will explain this, multiplied by market risk premium. Okay, and this all together will become this one, risk premium, which I want to absorb. Okay, means the for particular investor. If I multiply with the beta to market risk premium, then it is the risk premium for particular investor. Okay, we are calculating the expected rate of return for particular investor, so we need to consider the risk premium for particular investor. Okay, so first we understand the market risk premium. Market risk premium is basically the general premium. Okay, and it is very easy to calculate. So market rate of return minus risk-free rate of return. This is market risk premium. See, in examination, sometime you are not getting all the variables number. Okay, they may give the market premium. That means RM risk market return minus risk-free rate of return that they already gave. This is basically the market premium, market risk premium. Okay, they may say the risk premium for an individual portfolio. That means beta multiplied by risk premium, means entire this thing they gave in an examination. So you need to be careful while reading the question. Okay, so market risk premium is simple. What is my expected market rate of return and what is my risk-free rate of return? That is basically the market rate. Okay, I know the market risk premium. On that basis, how I can calculate my individual portfolio or individual investor risk premium? Okay, we need to multiply with the beta factor. What is beta factor? Say for whatever the portfolio I have or wherever I invested the money, they or I'll go with the market first. Means market may give a return of 10%. And in that scenario, I am getting a return of 12%. What does it mean? I am getting 20% higher return. Okay, so when the market giving a return of 10%, I am getting a return of 12%. So what is my beta? 12% divided by 10 equals to 1.2. Clear?
Sir, how did you get 20% high, sir?
see, depend. When you calculate the market rate of return, at that time there are certain loss making or the companies who are giving a less rate of return. Means every company is not giving an same rate of return. So it is an average for the market. Okay, but if I invested wisely and only top gainer means I invested only in those company who are giving a high level of return, so it may possible my rate of return is more than the market rate of return, and it can be vice versa as well. Like market rate of return is 10%, okay, and my individual portfolio rate of return is 8%. So in that situation, what is the beta? Again, 8% divided by 10, which is 0.8. Okay. See what happened if you think like Nifty. They consider the 50 companies. Okay, and they calculate their rate of return. So that becomes the market rate of return. Okay, which is the publish return. Okay, but I have invested in a 5 companies only. Okay, so my return is on the basis of average return is on those 5 companies, but the market rate of return is on the basis of 50 companies, like this. Or I may invested in some other company, not even in this 50 companies. Okay, so this way we need to calculate. Okay, so like beta is basically, what is the, beta means like individual return with respect to market return. Okay. So in clear terminology, we are not saying the return. It is basically the risk. Okay. Because if you are expecting a higher return than market, that means you are taking a higher risk. Okay. So beta represent generally the higher risk. Okay. If your return is 1.2, that means you are accepting a higher risk. That's why your return is slightly higher than market. Okay. And if it is 0.8, then you are considering the lower risk.
Sir,
Yeah.
so anything above 1% is high risk and anything below 1 is lower risk.
Lower risk. Right. Right. Okay. So
Uh,
because see, we are comparing with the market situation. Okay. See again, I means first government security, then market return, and then individual portfolio or individual expected rate of return. Okay. This is the safest one. Okay. Generally, market return is high, always lower than individual portfolio. Okay, generally. Okay, because again, the market expert decide where how much amount to invest where. Okay, so that's why the risk premium here is slightly less. Okay, and the individual portfolio always means it depend on the nature of the investor, whether he is an aggressive or the conservative. Okay, so risk premium here is high. Okay, now you need to consider one by one. Government security giving a 5% return, market return is 10%, and the individual expectation is 12%. So as the return increases, that means the investor is taking a higher risk. Okay. If this is 8%, that means he is not taking a higher risk than the market. Okay, and beta is basically the ratio between the ratio with respect to individual return with respect to the market return. Okay, so always beta is basically market is 10. If I'm consider 12, then it is 1.2, and if I consider the 8, then it is 0.8. That is my beta. Okay, I will break the formula, the same formula. and that also you need to keep in mind. This is basically the individual expected rate of return. How you are going to calculate, because you are not aware, means how I am going to calculate. Okay, so first, risk-free rate of return at any cost, means if I'm not taking a premium, still I need to earn a risk-free rate of return. If I'm not taking any kind of risk, still I need a risk-free rate of return. Okay, then I will write beta later on. First, what is my market return? This is market return minus risk-free rate of return. Sorry, what is my market risk premium? Okay, so whatever the additional return I am generating in a market, average market return, that is basically the market risk premium. Okay, and then I apply, if I am an aggressive investor, okay, I need a additional return on a market. So my beta would be 1.2 or 1.5, whatever it may be. But if I'm a conservative investment, so I may apply the beta of 0.8. Okay, and this way I'm going to calculate. So again, the formula is basically risk-free rate of return plus beta multiplied by market rate of return minus risk-free rate of return. Okay, it is easy to memorize. Okay, so that is basically the formula. Any doubt here? So you need to have a return more than the risk-free rate of return. Okay, then you need to calculate the premium. Okay, what is the formula for calculating the market risk premium? Market rate of return minus risk-free rate of return. Okay, and then you need to apply the individual risk factor, which is beta. How we are going to calculate individual risk factor? If market is giving a 10%, I need a 12%, 20% additional return. So it is 1.2. 50%, 50% additional return, then it is 1.5, like this. And then we calculate what would be my rate of return. Okay, I'll take a number. Say for risk-free rate of return is 5%. Plus 1.2 is my, because I am an aggressive investor. Okay, then market rate of return is 10%. My risk-free rate of return is 5%. Okay, so 5% plus 1.2 multiplied by 5. So it is 5, 5 plus 1.2 multiplied by 5 is 6. So it is 11%. Okay, so this way you need to calculate. So 11% is your expected rate of return. Clear? So okay, so here assumption is basically we are always consider the constant growth rate of return. Okay, so every year there is a single percentage, means it is not the same percentage. In the stock price will grow at the same rate as the dividend in perpetuity, and the formula assume that the required rate of return is greater than dividend growth rate. Okay. Now see, you can calculate, means how you are going to, in examination you may get the how I can say, you may get the several factors or the several information, how you are going to apply the dividend growth model or the perpetuity, means the annuity model, or the like CAPM model. Okay, so whatever the information you have, say for if the beta is given, then you need to consider this formula, like CAPM model. Okay, if you see there is a growth rate is not given in this formula, but if growth rate is given, then you need to apply the dividend growth model or Gordon growth model. Clear? Any doubt here? Okay, and sometime you may get the combined problem like this. Okay, means you will get the information, say for risk-free rate of return 5%, beta 1.2, then market rate of return 10%. Okay, after that growth rate they gave a 5%. Okay, and the last dividend paid, absolute amount paid 5,000. And now they want to calculate the value of the share. How you are going to calculate? Can you give a thought?
Sir, CAPM model.
Yeah, CAPM model. And what you, but in CAPM model, we are calculating the expected rate of return. We are not calculating the share price. Okay. If you want to see, they gave the growth rate and you want to calculate the share price, then you need to adopt dividend growth model. Okay. So, what is the formula for dividend growth model? D1 divide by expected rate of return minus growth rate. Clear? But you don't have the expected rate of return. How you are going to calculate expected rate of return with the CAPM model? What is this? Risk-free rate of return plus beta multiplied by market rate of return minus risk-free rate of return. Okay. Now you can see whether you have all the information. Okay. So sometime you may get the question like this. Okay. And if I start to calculate, so first we need to calculate the expected rate of return. Okay. How we are going to calculate? Risk-free rate of return is 5% plus 1.2 multiplied by 10 minus 5, which we already saw, it is come 11%. Okay. Then this 11% you need to apply in a dividend growth model. Okay. So 5,000 they gave the last dividend paid. Okay. So D1 is basically 5,500. They have not given the expected dividend. Okay. Divide by 11% minus growth rate is 5%. So it is 5,500 divided by 6%. Okay. And if I calculate this, so value of the share is 91,667. Are you able to get it? In this way also you may get the problem. Okay. Now we see the example given here. Baker Corporation pays a current dividend per share $5 per year. Okay, it is a current and is projected to grow at a 4% per year. Able want to invest in Baker and earn 20% return. Okay, so current dividend is $5. Okay, earn with a 4%. So D1, my D1 is 5 multiplied by 1.04. Okay, so this will 5.20. Clear? Then the price I am going to calculate 5.20, that you need to consider the P0, not P1. Okay, 5.20 divide by what is my expected growth return 20% and want to invest 20% minus 4%, which is my growth rate. So 5.20 divided by 16%. Yeah. And the amount is 32.5. This way I am going to calculate. Okay. So there is a difference in P0 and P1. P1 is basically after year end and the P0 is 32.50 before year end. So we are going to invest 32.50. What would be the price of P1? 32.50 plus 5.20. This will be my price of P1. Okay, so that is not the part of your this curriculum, so ignore it. But just P1 is basically whatever the amount I invested and on that whatever may be the dividend I received. So that is my closing value. Clear? Okay. So how we can use the CAPM and the dividend growth model together, that also we discuss. I hope you are able to understand on the basis of this formula. Okay, so you need to evaluate. See, there are three aspect only. One is basically the perpetuity, where the same dividend you are receiving. Okay, second is growth model, and the third one is CAPM. CAPM is last one. Okay, so CAPM we are not utilized for calculate the value of the share. So this is something different. Okay, so this will we are utilizing the CAPM model only to calculate the expected rate of return. Okay, if the expected rate of return is missing, that means they may give the information as per the CAPM requirement. Okay, and we need to calculate the expected rate of return. Okay, that you need to keep in mind. Okay, and then either you need to apply the dividend growth model, or you need to apply the constant dividend model. Okay, in constant dividend model, it is very easy. The same amount divided by whatever may be the expected rate of return. In both the formula, constant dividend model and the dividend growth model, you need a expected rate of return that you can calculate with the help of CAPM model. Any doubt here? Okay. Then how we are calculate the value of share with the discounted cash flow model. Okay. So there are two type basically. One is when you are invested in trading security. Okay, and you are invested in your own business. Okay, so if you are investing in your own business, that means you are acquiring the equity of that business. Okay, so what is the value of that equity? That also you need to understand. Okay, so and if you are invested in a trading security, then you can get only dividend or whatever may be the value appreciation. Okay, like we already saw, some amount we are getting a 30,000 we are getting an every year as a dividend, and the last year the value of the security or the securities which we brought at 1 lakh, okay, that we sold at a 1,30,000 or 1,10,000, whatever may be. Okay, so that is basically the example of invested in a trading securities. But if you are invested in your own business, in that situation, whatever may be the capital you are invested, this may be for the fixed asset as well as the working capital. Okay, okay, fixed asset is basically the one time, but the working capital you need to invest as and when required. Clear? So when you are invested in trading security is a one-time investment. You are invested one time, okay, then you are getting a return, and after the tenure or whenever you want to sell, you can sell it close. But if you are invested in your own business, in that situation, every time market determine what investment you need to do. Okay, why market determined? Because if the sell increase, then you need an additional working capital. You need to infuse the fund. If the sell decrease, then you may be in a position to withdraw the fund like this. Okay, so we need to calculate the free cash flow in that scenario. Okay, in dividend, like when you are invested in trading security, it is easy to calculate because you know the fixed amount what you are getting. Okay, but in case of the business, then you need to evaluate. Okay, so say for like every year sell is 100, 120, 150 and 200. Okay, and like, or instead of sell, it is basically the operating profit, sell minus all the cost. Okay, including depreciation. Okay, so while calculating the free cash flow, whatever may be the non-cash expenses, that we need to add back, and non-cash gain that you need to reduce. Okay, say for, I mean, the depreciation is an example of non-cash expenses, and the revaluation of the asset is an example of non-cash gain. Okay, so here there is no movement of the cash, so we need to make an adjustment. Okay, so non-cash expenses like depreciation, that we need to add back, say for 20 every year. Okay, whatever may be the revaluation gain, okay, so it is maybe the one time, okay, so that we need to reduce it, say for 10. Okay, so what is my free cash flow here? 100 plus 20 minus 10, it is 110, 140, then 170, and 220. Any doubt here? I hope you are able to understand. Okay, after that, means as I said, as I already informed, fixed asset is a one-time investment. But every year, because my sale get increase and whatever may be the increase, okay, I need to invest the 50% as a working capital. So here 100 to 120. So 10 I need to add here as a working capital. Okay. Then 20 to 50, 30 means the 15 working capital. And then 150, so 25 is my working capital addition. Okay, to calculate the cash flow, whether I need to deduct or add this amount, can anyone tell? So this is my profit. Okay, I adjusted the non-cash items. Okay, so it is basically the cash in a business. Okay, working capital we are investing. So what does it mean? Additional working capital we required. What does it mean? Cash in or cash out? Any guess? It may be in or it may be out. See, two options. You need to select one only.
Out, sir.
Out, correct. It is cash out. We are investing in a working capital. What does it mean? We are giving a support to our customer. That means the cash is going on, going out. Okay. So what is my this is my free cash flow. Means I earned some amount, out of that I reinvested, the remaining is free cash flow, means I can distribute to my shareholders. Okay, and then I need to apply the discounting factor. So discounting factor we need to calculate. A discounting factor is basically as good as like expected rate of return. And how we are going to calculate expected rate of return? By using the CAPM model. Okay, say for it comes by using the CAPM model, it comes by 11%. So it is basically after 1 year we are getting, so 1 divided by 1.11. Here also 1 divided by 1.11 square, like this. 1 divided by 1.11 cube and 1 divided by 1.11 4. So every year we need to calculate the discounting factor, and then whatever may be the amount we are receiving. Okay, so this will be my net PV of cash inflow. Okay, this is the present value of cash inflow. After that, I need to deduct the original cash outflow. Okay, because before start the business, I initially whatever the amount invested, that also I need to deduct original cash outflow. Okay, which will give me the net profitability. Net profitability or net present value. Okay. So see, whatever may be the value of this investment is basically the value of this. I means what happened? I invested 1 lakh. Okay. As per the net present value of cash inflow only. Okay. This value is 1,30,000. Okay. So net present value is basically the 30,000, no doubt. But value of investment means whatever the investment I did, 1 lakh. Okay. So because of I'm getting a profit, the value of those investment is 1,30,000. Are you able to clear? Okay, so value of the equity is basically 1,30,000, not 1 lakh minus 1,30,000 minus 1 lakh. That you need to keep in mind. This is my investment, and the value of this investment, market value of this investment is 1,30,000. Okay, we are using the same formula for other purpose as well, but here we are just calculating the what is value of my investment. I initially invested 1 lakh, and if I calculate all this thing and if I find net present value of my all cash inflow is 1,30,000, so value of this 1 lakh investment is 1,30,000. Clear? Any doubt? Any issue? No. Now, relative valuation model. Okay, so relative valuation model means what happened? We know the data of company A, all data. Okay, maybe it is a listed, so their all data is like appear in a public domain. Okay, domain, and the company B is a similar to company A in terms of size, in terms of the business, in terms of the size, business, in terms of everything. Okay, means the means whatever the product company B is dealing is more or less same in a company A. Company A's turnover, whatever may be the company A's turnover, the maybe the same level of company B turnover. Okay, so it is a similar to company A. Okay, if I don't want to use any formula and I just want to calculate my value of the equity on the basis of company A's value of the equity, so how I am going to do it? Say for PE ratio means price earning ratio. Okay, is 5 for company A. Okay, company B, they know their earning. Okay, but they don't know the price. So how they are going to calculate? They will use this market data. Means they assume if the P ratio of company A is 5, so P ratio of company B is also 5. So it is 5 divided by price divided by earning. If they feel their earning is $100,000, whatever may be. Okay, so 5 equals to P equals to 100,000. Okay, so then 5 multiplied by 100,000 equals to value of P, which is 500,000. So value of the company B is 500,000. So that we calculate on the basis of P ratio of the peer company or the similar company. EPS. Okay, so here earning basically we need to consider again the like D1. or even. That also keep in mind. I forget to explain. Whenever you are considering the earning and price should be the investment price and the earning should be the expected. Dividend should be the expected. Okay. So that also you need to keep in mind. Price always what amount you are going to invest and the earning always expected one, not the last one. Okay. And okay, so we will consider means okay. I means I already explained actually. Like if I have a E0 earning, so what I'm going to calculate the 1 year back price. It is P0 minus 1 like this. Okay, so I need to add E0 and then calculate the P0 like this. Okay, I'll explain that also. We'll take this example first. Assume the Baker Corporation has the current year earning per share of $1.5 and anticipate earning per share in the coming year of $2. Okay, so we need to consider 2 as an earning. Okay, if the PE ratio is 7.5x, calculate the expected value. So 7.5 multiplied by 2 is equals to 15. Okay, so here have they gave trailing versus P. Yeah, they gave E0 and E0. 7.5, so 15 is basically. So this is basically the forward P ratio. Generally, we calculate the value of the shares with the forward P ratio. But if you don't have an information because we are using the comparable, okay, so you can calculate on the basis of P0, E0. Okay, here they mention the trailing PE, but in that situation, we are considering the E0. Means if they mention the data for trailing PE ratio, then you need to consider the E0 instead of E1. Okay, so in that situation also, because we are here the comparison actually. So that's why if you consider the E0, means if you consider the P ratio with E0, then you need to consider your discount or your earning is also E0, means current last year earning like this. Okay. So, are you able to understand what I'm trying to tell here? E0 and E1 means for in forward PE, the formula is P0 divided by E1. But if they gave the trailing PE, okay, so it is basically the P0 divided by E0. Okay, so this is the data given, means the forward PE or given for the company A. Okay, but now you need to calculate the company B. Okay, so when you are using this PE, okay, you need to consider your expected earning, means the company B's expected earning. Okay, but if you are using trailing PE, then you need to consider the company B's last year earning. That is the only difference. So that is forward PE and the trailing PE that you need to consider. Any doubt here? No. So the PEG ratio is a measure that shows the effect of earning growth on a company's PE, assuming linear relationship between PE and growth. It is just like a growth model we are using. So generally stock that have a lower PEG ratio are more attractive to investor rather than the stock that have a higher PEG ratio. PE ratio divided by growth rate. So it is basically, say for my growth rate is 10%, then it is 1.10. Okay. So what the statement they gave, if you see here, generally the stock have a lower PEG, okay, ratios are more attractive. Means if the expected growth rate is high, then the value of the price is stock is reduced. Okay, so that's why if there is a lower PEG ratio, then it is more attractive. Means if your growth rate is high, okay, so it is difficult for the get the earning on your investment. Okay, so that's why investor mostly invest in a stock where there is a lower PEG. Okay. So how we are going to calculate? Means price, like if you break up this formula, so PEG equals to P0 divided by E1 divided by growth rate. Multiplied by 100% like this. Okay, so it is P0 as it is, PEG multiplied by growth rate. So it is 1 plus R or 1 plus GR divided by E1. That will be the formula. No, okay, that is also multiplied by E1 because we are calculating the P0. PEG.
Sir?
Yeah.
Sir, E1, is it for the next year or the
E1 is
just
next year. Expected.
Okay, sir.
Mostly, see, 90% cases you need to use the dividend or even for any calculation expected one. Okay, there is a only specific when there is a trailing PE ratio gave, so that scenario is very limited. Mostly assume that you need to consider while calculation D1 or E1. So this is basically the formula. So if you see, Baker want to use the PEG ratio to estimate the price of its stock. The company's PEG ratio is 2.5x. 2.5x multiplied by current earning is $5. The growth rate is 4%. So 5 multiplied by growth rate 1.04. Okay, and that also you need to consider, and the multiplied by growth rate 4%. So it is 2.5. Just a minute. Multiplied by 5 multiplied by 5.2 multiplied by 4%. So it is 52 or multiplied by 4, not 4%. 52. This way we need to calculate. PEG ratio, first you need to understand, this is price divided PE ratio divided by the growth rate. That is
Sir?
basically, yeah.
Aren't we doing the double calculation for the growth, because expected the dividend we are calculating for the period of 1 year,
Correct.
and then again we are multiplying
Growth rate.
into 4
Because that,
for the growth.
yeah, so see, basically this is basically the expected income for 1 year. Okay, and this we are multiplying because I'm getting a perpetual growth. Every year I'm getting a 4% growth rate. So that's why we need to, in addition to that, we need to add this. Okay, like if I consider only 2.5 multiplied by 5.2, then the price would be 13. If you see the like the previous example where like the if I have not applied the growth rate, then the value of the inventory is 33,000, and when I apply the growth rate, then it becomes immediately 1,10,000. So it is 13. But if I apply the growth rate, because I'm getting an additional, it is not the question that only this amount I'm getting every year. Every year my rate of return or the dividend I'm getting higher by 4%. Okay, so that's why it is a 4 time 52. Even if you see, like in a dividend growth model, what is the formula of dividend growth model? Can anybody recollect? D1 plus P0 plus growth rate, right? Okay. So here also, because means my rate of return is this one, and then I'm adding growth rate in addition to that. Okay, so this will be the additional earning every year. So I'm getting, means I'm getting every that much additional income. So that's why I need to factor once again. Here also, because if it is a D0, then it is just like a D0 multiplied by growth rate. But still I need to add back. That is basically just because of growth rate, the value of 33,000 increases to 1,10,000. Clear?
Sir, if any interim dividend is being given by the companies, will that be considered
Yeah,
as for
yeah.
evaluation for the?
Yes. That is also the part of the, if they are giving means we need to consider the total dividend, total earning. Okay. See, sometime what happened,
Okay.
okay, see, you may get an example, means good question actually. Share value is 100, you are getting a 10 dividend, and the closing value is 120. What is your expected earning? This is the expected closing value. And this is expected dividend. What is your expected earning? Can anyone guess? Any number? Maybe it is wrong.
120?
How much? 120. No, expected earning. This is the expected closing value of the shares. So
Okay.
my expected earning is 10% which I receive plus the appreciation in the value of the share. So it is 30. So whenever I am calculating, I need to use this number. Okay, actually it is even only. Okay, or E0. Okay, but in this situation we are not sure about the whatever may be the my price appreciation, because we are calculating the current price. So interim dividend, whatever may be the earning, that you need to consider for whenever you are calculating the value of the shares. Means in practical scenario also, that much complicated question you will not get in CPA, but whatever may be the expected earning during the year, in terms of the value of appreciation for the shares, in terms of the distribution of the dividend, that all you need to consider. Any guess here? Any doubt here? And this formulas you need to slightly memorize actually, but it is very easy because you are just using the comparable companies ratio and you are calculating your own shares. Okay. Okay. So here we will take a break of 15 minutes. Okay, so maybe we will join um, 8:50. Okay. Okay. Then price to sales ratio. Okay. I hope, am I audible properly? It is basically P0 divided by sales number. Okay, so whatever may be the sales number, generally it is not used. Okay, because there is no identical sales, and you cannot you cannot predict on the basis of sales number. Okay, but if you're doing or you are trading in an homogeneous product, and the product is like I can say deal in a perfect competition. Okay, so in that situation you can use this formula. Okay, so like if your peer company having a say for zero point 0.2 as a price to sales ratio, and they have a 1 lakh, so it is basically the P0 equals to 20,000, like this. So you are comparing with your yeah, again this is should be the expected one more point, expected sales. Okay, so see, whenever you are calculating the today's price, you need to consider all the factors, determining factor, which are the expected one. Okay, that you need to keep in mind. Then price to cash flow ratio, the same one. So cash flow generally we calculate on the basis of operating cash flow. Okay, so whatever may be the cash flow we calculate, so whatever may be the operating cash flow, that you need to consider. So again, same, like price to cash flow ratio. So here P0 divided by cash flow 1. Okay, means the expected cash flow. So it's the same thing. Price to book ratio means market price not always same with the book price. What is book price? Any, can anyone tell?
Is it the historic price?
Historic price, or whatever may be the like capital balances shown in the balance sheet. Capital balances means all the capital balances attributable common stockholder, not the preference stockholder. Capital balances as per financials. Okay, so we are comparing market price and book price. Okay, so here I think, see, the book price we need to keep at a 0 level. Okay, only this factor. Otherwise, always we take the factor of expected one. But here, the same period means the market price for the period and the book price for the period, or as on date, I can say same date. Okay. Okay, so if you see, an analyst assemble the following financial and market data for Bolden Corporation most recent year end. The analyst project the firm operating cash flow will increase 20%. Okay, so market data, common stock price, and the common shares outstanding, and then the financial data they gave. Okay, so as I said, cash flow from operation we need to use. Okay, and then here for price to cash flow ratio, we need to use the cash flow from operation, not the total cash flow. Okay, and for price to book ratio, what you need to do, either like common stock, additional paid-in capital, and retained earning. And yeah, so that you do not require to take the preference share capital. If you see that amount, we are not going to take 25, 45, and 50. 25, 45, and 50, 120,000, and determine the book of company equity per share. So number of shares given. So calculate the like P0 B0 equals to 1.5. This is basically the price to book ratio. Okay, and the cash flow, like we need to take an expected one. So here, cash flow zero is 25 million, and I think they gave the 20% increase for upcoming year. So 25 million multiplied by 20%, 120%. So that is 1.20, 30 million. So that we need to consider, and the number of shares given, the $3, and then market price divided by 3, which is basically the 6. That way we need to consider. Okay. So the price multiple ratios have similar assumption requirement, each of which can be influenced by management, including future earning, cash flow, sales, future growth rate, and duration of the sales, earning, or cash flow trend. So it depends on that. Okay. So where we are mostly we need to use the expected one. Okay. Only when there is a trailing PE number we are using, and like P0 B0 and a price to book value. Okay. So here we are not using the expected one. We need to use the current one. Okay. So that two things you need to keep in mind. So any doubt here? Okay. Now the option pricing model. So option is basically, I mean, there are two people. One is basically the buyer and underwriter. So buyer has an option. Okay. And underwriter is under obligation. Okay. So like a buyer of the call option or put option. Okay. So they can exercise the option on their will. They can enter into the contract or they can rescind the contract. But underwriter need to compulsorily execute the contract. Okay. Then the call option means right to buy. And the put option is right to sell. Then there are two more words, American style option. Okay, so that you need to keep in mind, means you may get the question on examination. And European style. What is the difference? In American style, you can exercise at any time before expiry. Okay, and in European style, you can exercise the option only on due date. On due date. Okay, so for like Mr. A enter into the contract of the option and the particular commodity X, okay, and he is going to call option, means option to buy, call option, okay, say for $10 per kg, okay, and he took an option for 90 days. 90 days. Say for today's date is 23rd August. Okay. So expiry date is September, October, November. I'll consider 27 November. Okay. So this way you can, you can take this example. Okay. So as per the American option, Mr. A can exercise the option any date between 23rd August to 23rd November. Clear? As per the American option style. Okay. As per the European option style, okay, you can exercise only on 23rd 11. Okay, hope I am able to explain the difference. Okay, in American option style, you can exercise the option on any date between August to November, and in European option style, you can exercise only on a due date. Okay, so that is basically the options. Option, first of all, right to buy or right to sell for the buyer of the option. Underwriter means who is the seller of the option. Okay, he is under obligation. He don't have a right. Okay. Then Black-Scholes model. So it is quite complicated actually. Okay, but and it is beyond the scope of the CPA exam. So we should not. Like if required, I can prepare tomorrow and I can explain because I already studied this. Okay. Then binomial model. Again, this is also the out of the course. Okay, now the valuation of debt instrument. Okay, so what I'll do, maybe tomorrow in a next week, I will give a just rough idea so that you people are aware about what is the Black-Scholes model and the binomial model. Now the valuation of the debt instrument. So it is not that much difficult for the equity. Okay. Bond. Okay. If you issue a particular bond with a face value of 1000, where you are committed to pay the interest at the rate of say for 5%. Okay. But the market interest rate is 6%. Okay. On the basis of whatever we learn in a perpetuity dividend, okay, if you apply the logic, can you calculate what would be the value of the bond? I mean, assume the perpetuity. The same principle, what we understand or what we learn in case of the dividend, the same principle you need to apply. What is my dividend? What is my expected return? Anyone? When I issued the bond, the value of the bond is 1000 or the face value I can say. Okay. And the stated interest rate is 5%. you can say the coupon interest rate. Okay, but the expected interest rate is 6%. Market interest rate means expected one. Any guess? I'm just correlating with the situation so that you can recollect the concept and memorize the concept. Okay. See, in case of the bond, there is no question of the growth model. So we need to use the zero growth model. Okay. So what is basically the cash flow in this situation? 1000, 5% of 1000. Okay, 50. What is my market interest rate? 6%. So it is basically the 6%. So value of the bond is 8,333. Okay, even though the face value is 1000, okay, trading value or investor is going to invest only if we can sell at a 803.33. What does it mean? Whether we are selling at a discount or a premium? Can anyone guess? Face value is 1000. I am selling at a 8,333. So whether I am selling at a premium or at a discount?
Discount.
Discount, absolutely. Okay. Now I'll reverse the number. Like this is 6% and this is 5%. What would be the value of the bond? Can anyone calculate? Again, the same logic. 1000, how much interest I am going to pay at 6%? Okay, market expectation is 5%. What is the value? It is 1200. So face value is 1000. I am able to sell because the investor is ready to buy at 1200. Why? Because he is getting a more interest than the market. Okay, so I am selling at 1200. So whether I am selling at a discount or premium?
Premium.
Yes, so it is at premium. So whenever I am selling at a price higher than face value, it is at a premium. Whenever I am selling at a price lower than face value, it is at a discount. Now we need to see this example. A 1000 face value bond maturing in a 3 years. Okay, that we discuss for a perpetuity, but here there is a clear cut time bound. Okay, 3 year pays an annual interest rate is 4%. Calculate the bond price if the market rate at the time of issuance is 5%. Okay, so how I am going to calculate? Like I assume whatever may be the redemption value means see what happened, 1000 I invested. Every year I am getting the 4%. 4% is basically the 40. Okay, first year, second year, third year. At the end of third year, I am getting return back my amount 1000. So my cash flow for this investment is in a first year 40, second year 40, third year 40 and 1000. Okay, this is on third year. Market rate of return is 5%. So again, I need to discount. Okay, so it is basically I'll just 40, 40, 40 and 1000. Okay. Market rate of return is 5% means I need to calculate the discount because a discounting factor 1.05. sorry, same, because on at the end of third year I am getting my initial investment as well. So this is 972.77. Why I'm calculating like this? Because it is for a limited period. Earlier way of calculation is when we are issuing a bond with a perpetuity. Okay. So value of the the present value of the investment, today's investment of 1000 is 972. Okay. So in that situation, what would be my whether this would be my selling price. So I'm selling at a discount. Okay. Are you able to understand? Because it is for a limited period, so you need to calculate with a discounted cash flow method. Okay. If it is a investment is for perpetuity and this is a bond, so there is no question of arises of the growth rate. If it is an equity, then question of growth rate is arises. So you need to use the zero discount model. Okay. So any doubt here? When it is for limited period, you need to calculate the cash flow, discounted cash flow, okay, and you need to consider the discounting factor with a market rate of interest, okay, and the amount which you are receiving, that you need to consider with the stated rate of interest. And if it is a perpetuity, then the earlier way of approach we need to adopt. So any issue up till now? Okay. Now the value of tangible asset. What are the tangible asset?
So anything which has like a physical existence.
Existence, and we can see visually. Okay, so land, building, property, plant and equipment. These are all tangible asset. Okay. So how we can calculate? So first is basically the cost method. So cost method is generally means we are considering the historical method. So whatever may be the cost incurred to bring the asset in a usable condition. Usable condition. So that we need to consider. Okay. So, and then further we are charging the depreciation on year basis. Okay. So the represent deterioration of the value of the asset. Okay. So in cost method means whatever may be the purchase cost, transportation, installation and commissioning, that all we need to consider. Means even trial run also we need to consider. Okay. And like on year basis, we charge the depreciation on the basis of useful life of the asset. Okay, market value. So market value generally means how we are going to calculate. If we know the value of the identical asset, then we can use this. If we know the value of the similar asset, then with respect to certain adjustment, okay, we need to accept. And the third one is, if we don't have this one, then you need to on the basis of discounted cash flow method. This way we calculate the market value. Okay. So this method requires the similar asset be available in the marketplace in order to find the comparable value. Two iterations of the market value method are the replacement cost method, what it would cost to replace the value of the asset, and net realizable value method, the price at which the asset could be sold in the marketplace reduced by the cost associated with the selling of the asset. Okay. Here like replacement means if I'm bringing the new asset, then what price I need to pay? And NRV, if I sell the asset, what net amount I can realize? Okay, so generally this is basically the priority one. Okay, if there is no active market involved, then maybe we can use this second priority. So companies assessing the value of the equipment at its headquarters using the market value method, the company determined that it would cost 6.2 million today to replace all of its equipment, and the company also determined that the selling its equipment in the marketplace would generate 5.9 million after accounting for selling of disposal costs. Either value may be used as a reasonable proxy for the market value. Okay, but generally, like we generally use the first priority of this one and the second priority of this one, but you can use any value. Appraisal method. So under this method, the professional appraiser determines the value of the asset, assuming that the company can find an appraiser with the knowledge and experience working with the specific asset in a question. So appraiser means valuer give the valuation. So there are so many government approved or particularly licensed set valuer. So they give the value. Liquidation value. If the asset had to be sold today, the liquidation value represents the amount that the company would get upon sale, assuming that there is an active market for the asset. So it is the same. Means if you sell the asset, so whatever may be the value, you are going to realize. Okay. So that is basically for the valuation for the property, plant and equipment, means the tangible asset. Then intangible asset. So intangible asset mostly, can anyone give the example of intangible asset?
Patents, goodwill.
Yeah, patent, goodwill, copyright. Okay. So those assets which we cannot visually see but carrying some value. Okay. So that is intangible asset. So the approach requires that actual arm's length transaction, sale, transfer, license in a similar market we use as a reference for the asset to be valued. Means if we have a similar asset having an active trading, okay. So in that situation we can take the reference. Although this is a preferred approach to valuation, the unique nature of individual intangible asset and relative trading infrequency present the challenge. Okay, so here we can see a company has a patent in its intangible portfolio that is looking to monetize. In the looking at a recent transaction for a comparable patent sale, the company discover 4 within the last couple of years: sale 1, sale 2, sale 3, sale 4. The company will took to assign the value within a range of 51 to million to 18.5. So this is basically the highest value to the lowest one. Okay. Perhaps using the median value is 16.5 million, or the company may identify the transaction involving the asset that is closest to the nature of the patent of the company and looking to sell and use that value. Okay. So whatever may be the reference available, either you can take the average one, or if you see the more identical or the more similar asset, that you can take as a reference. Income approach. So using this approach, the future expected cash flow over the estimated useful life of the intangible asset are discounted to present value using the discount rate reflecting the level of risk. Okay, so that is basically like, if because of use of any intangible asset I am earning some amount, okay, so that I need to discount and calculate the present value. Okay, so like Eagle Road Enterprises own a patent that is expected to generate 4 million each year for next 10 years. So using the discount rate of 5.5% and the discounting factor, this for 10 year, it may give in a question. Discounting factor is 7.5376. Okay, so then the 4 million every year. So present value of this 10-year amount is 4 multiplied by 7.5376, which is 30.15 million. So this is basically the value of my intangible asset. So in income approach, we generally calculate the cash flow, free cash flow, and then we apply the discounting factor, and whatever may be the sum of all the discounted value, that is basically the value of the asset. Cost approach. So when there are no similar asset or transaction involving similar asset and no reasonable estimate of the future income, the cost approach can be used. So iteration of the cost approach include replacement cost, expenses required to create a similar asset, and the reproduction cost, the expenses needed to reproduce the same asset. So cost incorporate will include material, labor, overhead, legal and other fees, development cost, production cost, and opportunity cost. So whatever may be the cost incurred, that we need to consider. Okay, plus opportunity cost. Means if I invested this amount to some other issue or some other earning opportunity, so whatever may be the earning sacrifice, okay, that also I need to consider in cost approach. Okay, so all cost we need to consider, and plus I need to add the opportunity income. Okay, if I have not invested in this, so I may invest somewhere, and because of that reason I may lose some earning opportunity. Okay, so that also we need to consider. So generally, like the interest rate, you can consider as a opportunity income. So you can see here, Alpine Inc. looked to establish a value of the copyright in its intangible asset portfolio. Using a valuation date of today, Alpine determined the following value for the cost associated with the reproducing the same copyright. So labor, material, overhead, legal and other fees, development cost, production cost. Opportunity cost is basically whatever the amount invested here. Okay, so if I invested somewhere, then I may earn some amount. Okay, so whatever may be the loss opportunity, that also I need to consider. So total cost is 112,000, that I need to consider the cost of copyright as per the cost approach. Then valuation using the accounting estimate.
Sir,
Yeah.
how do we calculate the deferred tax assets?
No,
Because it's an intangible.
yeah, deferred tax asset is basically, that is the altogether different concept. This is asset, but it is not because of any value addition. It is what happened, like as per income tax. Okay, if you are paying higher tax, or there is a certain income or the certain expenses which you can postpone, which you cannot claim immediately. Okay, and because of that reason, you are paying a higher tax. Okay, and subsequently you are going to claim the credit or reversal in next year or subsequent year. Okay, so because of that reason, whatever the amount you paid, okay, that will become the advance tax, like advance tax. Okay, and if you are paying as an advance tax, okay, so that will become your asset. Say for, I'll just give you, means the certain payment, certain expenses, where, how I can say, certain expenses where allowable as a deduction on the payment basis. On payment basis. Okay. So if you incurred those expenses for a previous year, say for 2025, okay, so you book as an expenses in 25, okay, but you cannot claim the deduction because you have not did the payment. Cannot claim deduction. Okay, so you need to pay tax in 2025, even though you incurred the expenses for 2025, but you need to pay the tax in 2025. Okay, which can be offset against 2026 liability. 26 liability. Okay, so for 2025, you paid the taxes in advance. Okay, so that reflected as a deferred tax asset. Okay, this is basically the concept of deferred tax. In 2026, this is not the your expenses. Okay, but you did the payment in 2026. That's why you can claim as a deduction. Okay, so in 2026, your tax liability is less. What does it mean? You paid the taxes in 2025. That's why you need to pay a lower tax in 2026. So whatever may be that additional taxes you paid in 2025, that is treated as an advance tax, and that's why we need to create the deferred tax asset. Okay, so it is not basically the how I can say the trading or sellable asset. Okay, so that's why we do not require to do any valuation. Deferred valuation of deferred tax asset and liability is depend on the Income Tax Act. Okay, then valuation using the accounting estimate. So certain financial statement line items are valued using the accounting estimate. So account receivable is present net of allowances for uncollectible account. Why we are saying accounting estimate? AR. And yes, whatever may be the AR balances, okay, we are not aware whether the entire amount is receivable or we can recover. So that's why we generally make a provision for doubtful debt. Provision for doubtful debt. Okay, and that we reduce here. So this provision for doubtful debt is basically the estimate. Okay, so that's why we need to we can say the valuation of account receivable on a estimated basis. Inventory is reported at the cost, lower of cost or market or lower of cost and net realizable when valued, including the write down of obsolete inventory. So write down also we are doing on the basis of estimation. So that's why we need to consider this as a estimated basis. So particularly current asset, all the current asset and current liability we valued at a estimated basis. Okay, and the fixed asset where we charge the depreciation. Okay, offset by accumulated depreciation. Depreciation is also the estimated expenses. we are not aware whether the useful life or not confident whether the useful life of the fixed asset we can determine. So that's why we just have some thought or some prediction that we are going to use this asset for a 10 years, and accordingly we charge the depreciation. And the contingent liability are based on the best estimate of probable future losses. So contingent liability, we make a provision for the contingent liability on the basis of estimate only. So that's why all the, this asset, particularly the current asset and current liability, we calculate on the basis of estimation. Then preparing the accounting estimate, how we are prepare the accounting estimate. Okay, so historical information on the basis of past trend. So gap requires that the allowances for uncollectible account be estimated using historical information regarding the collectability of the company's receivable from its customer. Historical pattern of fixed asset usage may be used to justify the method used to prepare the depreciation on fixed asset. So means whenever we are deciding any percentage of allowances, that we need to evaluate on the basis of past performance. So that's why the historical information we are going to use. Then market information, particularly for the inventory valuation. Information on the current value of inventory item you should be used to determine the lower of cost or market and lower of cost and net realizable value, and should also be used to determine whether inventory should be written down or written off due to obsolescence. Okay. So like if you have a particular item and you are not getting order for that item since last 3 years, that what does it mean? We consider this as an obsolete item. So it is an estimation. We don't know really it is obsolete or not. Okay, but that is on the basis of market information. Then expected usage depreciation method we just discussed. Okay, so we are not aware actual useful life of the asset. So we generally estimate the useful life of the asset and estimate from experts. So attorneys are used to, for contingent liability, generally we need to approach to the attorney or the legal advisor, and then they estimate what would be the probable outcome of the particular liability or particular litigation. Okay, so this way we need to evaluate and prepare the accounting estimate. Okay, so can you give any example beside provision for doubtful debt or whatever the like depreciation or the provision for doubtful debt, any other example where we are using the estimated estimate basically? This two if you ignore, any other?
So goodwill we are amortizing.
Goodwill amortizing, yes.
The provision for taxes.
Provision for taxes, this is as per the tax rule. It is not the estimation. Any other?
So goods lost in transit.
No. If any situation happened then and only then you are deteriorate the value. Any other? Warranty claim. Okay. Then the leave encashment. Oblique gratuity. Okay. So these are some more example where we are using the estimate. We are taking a valuation from the expert. Okay. And then we make a provision. Warranty claim is also on the basis of past situation. Okay. We decide what amount of warranty we need to give or whatever may be my warranty expenses. Okay. And accordingly we need to make a provision. We need to estimate and then we need to make a accounting entry. So review and approval of the accounting estimate. Okay, so see what happened whenever you prepare the financial, it should not be the case that you are biased and so you feel okay, I want to show this profit. Sometime profit is high, but you want to show the less profit, so that's why you make a additional provision. And sometime profit is less, and you want to show the higher profit, so you may show the lower provision. That should not be the case. So that's why the accounting estimate should be supported by documentation that shows the assumption and calculation upon which the estimate are based, and management should regularly review the support of material accounting estimate and should approve each estimate when reviewed. So company that use accounting estimate should expect their auditors to closely scrutinize the assumption and support underlying the estimate. Auditors expect accounting estimate to be reasonable and look closely at any information that contradicts the assumption made by management when preparing the estimate. Then fair value measurement. Okay, so value of estimate generally prepared by someone and it is reviewed by the management. Okay, fair value management measurement. So fair value terminology. Okay, so means in general practice, what you can say this as a fair value of the property or the any asset. Any guess? I'll give an example. Means market price is okay. Okay, see market A and market B. Same asset you can say for you can sell in a US, you can sell in a Germany. Okay, if you sell in a US, you will get the 10,000, but you need to incur the cost of 2,000. Okay, if you sell in a Germany, you may get the 11,000, but you need to incur the cost of 4,000. Okay, what would be the fair value of the asset? Any guess? Okay, so four option is basically 10,000, 11,000, 8,000, and the 7,000. Answer should be out of this four. Maybe it is wrong, no problem, but at least you can start to guess.
Is it the amount which we which we get after incurring the cost?
No, you can, yeah. So, no, that should not be the case because incurring the cost is basically the subsequent event. So, while valuation of the asset, we are not going to consider. We may consider for gain and loss, but that cannot be the part of valuation of the asset. Okay. So, as with this explanation, and I mean, this two cannot be the answer. Now, you need to select from this two. Means keep in mind, value of the asset we need to use. Okay.
The lowest one,
Which one?
10,000.
Okay. Why it is, means your answer is right, but because it is the lowest, is it, I mean, that would be your logic? Because if you compare 10,000 and 11,000, so on a conservative basis, you want to use the 10,000. Is this your logic?
Yes, sir, because the fair value is the expected which we think of. So better is the lowest
Okay. So, yeah.
according to me.
Okay, understood. Okay, but that is not the logic behind it. Okay, so how we calculate? We need to see first what is the most advantageous market. Okay, most advantageous market. Most advantageous is 8,000 is a net gain. Okay, if I compare the net gain or net realizable value, so 8,000 is higher. So this is the most advantageous market for me. Okay, so I need to pick up the value from the most advantageous market, and value of the asset is basically, I mean, the selling value is 10,000. This I am going to incur the expenses later on, so I am not going to consider this one. My asset value is 10,000 or the sellable value is 10,000. So I need to value my asset at a 10,000. When I am going to sell, at that time I am incurring the transportation or whatever may be the expenses, and then I consider for the profitability. Okay, so first you need to pick the most advantageous market, okay, and that you can calculate on the basis of most advantageous net realizable value, okay, but you need to consider the asset value as a realizable value, not net realizable value. Okay, so this way you need to consider. We'll see one by one. So orderly transaction, an orderly transaction is one in which the asset or liability is exposed to the market for a period before the measurement date, long enough to allow for marketing activities that are usual and customary for transaction involving such asset or liability. An orderly transaction cannot be the forced transaction. Means in the normal scenario, whatever may be the sale purchase may happen, that is basically the orderly transaction. Market participant, that also you need to consider. Okay. The market participant are buyer and seller who are independent, not related parties, knowledgeable about the asset or liability, able to transact for the asset or liability, and willing to transact for the asset and liability. So they are considered to be acting in their economic best interest. Okay. So any unrelated seller and buyer, they are considered as a market participant. Now, principal market means orderly transaction. In a normal situation, transaction happened. We are not selling in a forcible way. Okay, or someone is not going to buying out of love and emotions. Okay, so market participant means the buyer and seller, and now we need to see the primary market. Sorry, principal market. As we saw, means like US market. Okay, here the trading is basically the 80% transaction, and the Europe or Germany 20%. Okay, so where is most active market available or the greatest volume available?
US market, sir.
Okay, so if we have this information available, okay, so then we need to consider automatically this price. Okay, you do not require to go to check which is the most advantageous market. Okay, because you are aware about the principal market. Okay, most advantageous market we are using if the US, Germany, okay, both having a share of 50% and 50%. Equal market size or multiple market where you cannot conclude, okay, what is the principal market? Then you need to adopt the approach of most advantageous market. Okay, so the principal market is the market with the greatest volume or level of activity for the asset or liability. If there is a principal market for an asset or liability, the price prevail in that market will be the fair value. We need to consider fair value measurement, even if there is a most advantageous price in a different market. Okay, so first you need to evaluate whether there is a principal market. If the principal market is available, okay, again keep in mind, if the principal market is available, then you should not evaluate most advantageous market. Whatever the price given in the principal market, that you need to consider as a fair value. And if the principal market is not available, then we need to go with the most advantageous market. Okay. So most advantageous market is the market with the best price for the asset, maximizing selling price of the asset or liability, minimize the payment or transfer liability after considering transaction cost. Okay. So here given after considering transaction cost. Note that although the transaction costs are used to determine the most advantageous market, the transaction costs are not included in the final fair value measurement. Okay, so we will see this example. See, we record the asset at the fair value. Okay, transaction cost we are incurring later on when we want to sell the asset. Okay, so transaction value cannot be the part of the fair value, but we need to consider the transaction value to determine the most advantageous market. Okay, now we can see this example. Getting hold Foxy company stock which trades on two exchange. Getting can access both the New York and London market. Okay. So in New York, quoted price is 52 and the transaction cost is 6. And in London, the quoted price is 50 and the transaction cost is 2. So 46, 48 given. So what would be the value of the asset? We just discuss. And assume there is no principal market. If the principal market information is given, then you do not require to evaluate what is most advantageous market. Any guess?
London, sir.
London. Okay. So what is the value of the asset? Fair value of the asset?
Realizable value is $50. Net realizable is 48.
So what you can consider as the fair value of the asset? 48 or 50?
50, sir. 50.
Yeah, 50. Yes, correct.
50.
So what first we evaluated, first we evaluated there is no principal market, then we evaluated which one is most advantageous, which is 48. Okay. So London is the most advantageous, and then we need to consider only the quoted stock price. We should not consider the transaction cost. So 50 is the quoted stock price, so that we need to consider. So if no principal market with the London price net of transaction cost having the most advantageous result of 50. Okay. Then highest and best use, non-financial asset. So fair value measurement of non-financial asset takes into account the market participant ability to generate the economic benefit by using the asset in its highest and best use or by selling it another participant that would use the asset in its highest and best use. Okay. So okay. So I'll take an example so that you can understand. Like okay. Say for you have a land. Okay. So land you can use, either you can sell it as it is or you can develop the plot and then sell. Okay. If you sell as it is, then you may get the 1 million. Okay. And if you develop the plot and sell, then you may get 1.5 million. But you need to incur the expenses of say for 60,000 or 600,000. Sorry. Okay. So this is basically the 900,000 net realizable. What would be the value of like for this asset? Any guess for non-financial asset?
So can you repeat once again?
Okay. So I have a land which I can sell as it is, which give me the value of 1 million. Okay. Or I can develop a plot and then sell. This will give me the value of 1.5 million, but there is an additional expenses of 600,000. So net amount is 900,000. So what would be the value of the asset? Value of the non-financial asset. Yeah.
If we look for the most advantageous, then that will be the directly selling because we are earning 1 million.
Yeah, correct. Okay, so we need to consider this. Okay, why we are, I mean, saying this is a non-financial asset land? Any guess?
Because it's an investment for more than one year. It's not a recurring activity.
Any other? See, this is not for active, means we are talking about the business point of view. So we have not purchased it for selling or reselling. Okay, so this is not for, I mean, so we don't have a active, we are not planning to create any active market. So that's why it is basically the non-financial asset. Okay, sometime what happened, like debtors that can be recovered in over a 3 year period, but that is still financial asset because we are going to, I mean, we procure something for selling. Okay, if we are procuring something for not for selling, then we need to consider this as a non-financial asset. Okay, the highest best use concept is not relevant when measuring the final value of the financial asset or the because such items do not have a alternate uses and their fair value do not depend on the use of. I mean, like current asset, current liability. So there we cannot use the highest and best use. Okay, only for non-financial asset we need to use for a the alternate use. I mean, where we have an alternate use, so we can use the best use of the asset. Okay. Then illustration. As a part of business combination, a reporting entity acquires a land that is currently the site of a factory. Similar site in the area were recently developed for other purpose, including the residential and retail space. The highest and best use of the land would be determined by comparing the both the following. So we just whatever we will discuss. So value of the land as currently developed for industrial use, value of the land plus the value of the asset and liabilities related to the land, such as the building cost, debt on the land and building, and the value of the land as a vacant site for residential or retail use. The cost of tearing down the factory and any related cost must be considered, as well as any uncertainty in converting the land to a vacant site for a residential or real space, retail space. So fair value will be determined based on whichever use result the highest value. Okay, so whatever may be the opportunity, we give a better result that we need to consider. Okay, so financial and non-financial, keep in mind, means if I buy the material with the intention to sell and there is no other alternate. Okay, generally it is, we don't have an alternate, because if I'm buying for intention to sell, so I'm going to sell it. Okay, so in that situation we need to we cannot use the alternate value addition method. Okay, and if it is a generally it is a fixed asset only, so where we need to use, we can see whether we need to utilize for alternate purpose, and accordingly we need to make a valuation, means whatever the valuation in a most advantageous situation that we need to consider. Okay, any doubt here?
No, sir.
Okay, so we are going to stop here, and this is again the like bigger topic, so that we will cover in tomorrow's class. Okay, anyone has any issue related to evaluation process, or all clear to everyone?
So once we get 120 credits, then only we can start applying for the evaluation, right?
Not necessary. Sometime with the 3-year BCom also you can. I mean, like particularly the Montana state, they are not insisting 120 credit. They need an accounting credit. Okay, so that can be covered in BCom graduation.
For the US and other states, sir?
Sorry.
For the US and other states?
Some state they expect 120 credit. Okay, but like Montana is also good state. Most of the Indians are doing CPA from Montana. Anyone has any other query? Okay, so if no one has any query, so we can close the class for today.
Yes, sir.